Hi everyone, this is Jitendra Gupta. Today I am going to talk about Embassy Office REIT which is opening today for investments. Let us briefly understand the business and the concept. It's a real estate investment trust where it sponsors Embassy Group and Blackstone, who have created close to 74 commercial real estate assets, are actually pooling these assets into a trust, and that trust will be listed. So as a unit holder of the trust, you will be part owner of these assets. So it's very simple. 90% of these properties are already occupied, and close to 43% of its tenants comes from the Fortune 500 companies. So company or the trust generate a rental income from these properties, and which after deducting expenditure, taxes and other management fees would be returned back to the 100% of these rentals would be returned back to the unit holders in the form of 50% in the form of dividend and 50% in the form of interest. So it's like a debt instrument where you have a regular cash flow, regular income. So one should look at this product as close to a debt instrument. Now let's talk about investment highlights. It's slightly less risky. The trust will be run by very highly skilled managers and very professional managers. In terms of diversification, its properties have got presence across the cities in the country, and as I said, most of its clients are Fortune 500 companies. In terms of the clients, they have a well diversified industry exposure. Very important, its balance sheet is it's not very highly leveraged. Its debt to equity ratio or debt as a proportion of the overall capital is very low. So that makes a little less risky in terms of instrument. Second, the company is deleveraging its balance sheet further. A bulk of the IPO proceeds would be used for retiring its debt. So it's very important. Let's say tomorrow or in future the company wants to acquire a particular asset or a project at say IRR of 18 to 20%, as against the current offered yield of about 8.5%. That will create a lot of value for the existing shareholders. Third, there is room for growth. As I said, large part of the properties are occupied, almost 90%. But as the proportion of the occupied properties go up, the cash flows going forward will improve. And within that, one should also account for the fact that there are rental renewals pending over the next 1 or 2 years. As and when these rental agreements expire in the coming years, there will be a mark-to-market gain because of today most of these rental agreements are sitting in the books at very low prices as compared to the market price of these properties, or the market rentals are far higher than what the agreement says. So because of that, once these rentals comes for renewal, there will be a gain for and there will be improvement in the cash flows. Third, the company is actually doing in-house campus programs through looking for various sources of revenues. Like they are building hotels, they are doing advertisements and other stuff to generate a sort of a second source of revenue. Now when it comes to valuations, the units are valued or offered at an NAV of 299 rupees to 300 per unit. At the offer at that particular price, the yield works out to about 8.5%. So if you are an investor in those units, you will be entitled to earn a yield of almost 8.5%. But however, after adjusting for the taxes, the yield comes down to 6.9% as against, as I said, 8.5%. Finally, I would say while there are triggers for yield moving up in the future, It's investor should have a very low expectations, and remember it's a fairly complex product, and there are certain risks associated to such kind of products which may or may not be suitable for the retail investors. So that's all from my side. For more information, please log on to moneycontrol.com.